What's up, everybody? It's your boy Dave P with my main man, RJ Pepino, and we are full-time real estate investors. If you don't follow us already, make sure you hit the follow button. If you're into everything when it comes to real estate, making money, that's what we're all about. We're entrepreneurs. We've been doing real estate full-time. Really, I started back in 05, 06. RJ started shortly after that, and we've been buying houses in our market here, Columbus, Ohio, since 2012 together and building a rental portfolio. We're very bullish on the affordable housing sector. That's our main business, but we pay attention to every single market that's out there. And today, it's the end of January 2022, and the whole month of January has just been a bloodbath in the stock market. And a lot of that has to do with the fact that the Fed is threatening to raise interest rates. And today in this video, we're talking about how rising interest rates can affect us as real estate investors. So we're going to get into that, but first off, kind of just a little bit of an explanation on why the stock market is getting crushed. The plain and simple reason is that a lot of these companies that are trading in the stock market, number one, they're at all-time highs, but number two, the NASDAQ specifically is full of these companies that don't even really make profits. They're just living off debt. So when interest rates go up, that affects their cash flow and affects their balance sheet. So now they're already not making profits, and now they're going to be making even less money. Their expenses just went up when interest rates go up, so their stock price gets obliterated. RJ, how you feeling today, and what's on your mind?
I feel good. I still don't understand the concept of how can these companies even run knowing that they're not making any money at all. You know, we don't run our business like that, you know, so it's like they're just running on, we'll just say, Fugazi money. And, you know, at one point, it's going to all blow up. And we're starting to kind of see that a little bit in some of these companies that you're going to be talking about with, you know, in that, what was that ETF that you were talking about?
We were talking about ARC Innovation. Kathy Wood's fund has come down like over 50% since its all-time highs. But just to give you a quick explanation, it's good because I think a lot of our viewers are probably thinking the same thing. How did these companies even work? Yeah. Well, think back to the tech bubble back in the year 2000. There was a website for everything. There was pets.com, plants.com, you know, lights.com, all of these, you know, websites. They went IPO, or initial public offering. They went public in the stock market. So a lot of people were throwing money at them. It's kind of like a bet. You're hoping that plants.com ends up becoming a profitable company. So you buy the stock now, and you're hoping it's going to continue to grow and become profitable. But a lot of those weak companies, they got shaken out. They're not even around anymore. They all went away. But out of those, you know, out of that bubble came Amazon, right? Amazon was trading at $100 a share back then, you know, during the tech bubble. That's when they came during the birth of the internet and all that stuff. So if you would have made the bet on Amazon then, you would be doing really well right now. So the high growth companies like DocuSign and Zoom and Netflix and a lot of these companies, they don't really show profits on their balance sheet, or they don't really like make a lot of money. But the reason you would buy that stock is you're betting that the company is going to be something bigger in the future. Yeah. So it's like a little bet, and that's why the stock price keeps going up, because all these people are betting on the same stock, so that drives the price up. But now what we're seeing in specifically the NASDAQ is the threat of interest rates, and now reality's starting to kick in. It's like, okay, these companies don't make a lot of money, their balance sheet is starting to shrink, their debt's about to go up, they're about to be doing even worse off. So the stock, people start selling. They're like, oh, we're at the top. And that is why there's a lot of selling in the markets right now.
You mean you made that call, though, back in November?
I made that call a while ago, but it was, I mean, not that difficult of a call to make, because the stocks were trading at all-time highs, and it was just a matter of time. But not all stocks are getting beat up. I mean, I am very much a conservative individual when it comes to stock picking. But, you know, that's where, like, the value plays are doing great in dividend-paying stocks. I shared a chart with you. Berkshire Hathaway, which is Warren Buffett's fund, that's just been a steady climb, you know? And then you compare it to like some of these high growth, high flying tech plays like Kathy Wood's ARC Innovation Fund that went straight up and came straight crashing down. Well, now Berkshire Hathaway is actually beating ARC Innovation Fund, you know? So it's like the classic tale of the tortoise and the hare. The tortoise is slow and steady, just continuing to increase. When the hare is like the fastest one out the gate, goes shooting up, but also comes crashing down. So there's still money to be made in every market. It's all about the value plays right now, and that's kind of how we've positioned our real estate portfolio as well. And we are very much into like the value plays and the affordable housing. That's why it's a little bit safer, right?
It's key, right? Because that's the market that doesn't really get too affected when the rates go up. The markets that do would be the luxury markets, the houses that are in our market here in Ohio, 500, 400 to 500, even to $1 million homes. One little spike like that means payments are just go out the door, and they're not affordable anymore, which affects your renters, your house buyers. I mean, that pool already is really low. And so when stuff like this happens where you have a blip, I don't know what it increased to. It's like
they haven't even, this is the funny thing, everybody. All of this is happening just basically on the threat of interest rates going up. They haven't even raised them yet. The first rate hike is supposed to be March 25th, but we'll see if the Fed even gets there. Things are imploding so bad right now, they might call the whole thing off. We don't know.
So even a small 0.5% increase in a high dollar market, you're going to see your payment go from, let's just say $2,500 a month, all the way up to maybe $3,500 a month, and that really stretches people out, So that's why we stay in the affordable housing zone in the 150 to 250, 100,000 market, because there's more buyers, there's more renters, and you don't really see that big of a blip in your payment.
You made a great point. The luxury homes could be compared to like a high growth type of stock. It's like, hey, as long as this thing keeps going up, we're going to make a lot of money. You could make huge profits. You can make, you bought this $650,000 house and the market's charging and the market's going up, and you think you can sell it for $850. That's a huge potential spread. But if the market changes, if the interest rates go up, that's the first one to go away. So you're talking about the buyer pool. When rates go up, there's less and less buyers for the high ticket stuff, because that's, the least affordable type of real estate. And the more value-oriented play would be like what we buy, which is like affordable housing. It produces a steady cash flow. You're probably not going to see those increases of the 200,000 increases like you would a luxury home, but it's also a more safe play that's going to produce a steady, consistent cash flow. And when rates go up and those prices in the luxury homes are falling $200,000 rapidly, you're not going to see those big declines in the affordable housing. That's kind of why we prefer, it's a little bit safer play.
Well, we just had a refinance quote, which was really surprising to me. It jumped that high, but originally they quoted us 4.25% on an interest rate, and we just saw the email today, and they were really close to 7%, which is typically that's like hard money terms. So we had to respectfully decline that. But do you foresee that companies like that, those nationwide lenders, are going to start increasing this with this like looming, 100%. Doom and gloom of the interest rates?
Absolutely. And so the Fed, ultimately, they control the interest rates, right? They are in charge of, when the rates go up. But these companies who are lenders, they're already pricing in the rate hike. They're acting as if the rates have already gone up. They have to price in these loans as if it's already happened. So yeah, I mean, even the threat of interest rate hikes, it makes the lenders start selling their loans as if it's already happened. And so the Fed is basically saying the first interest rate hike, it's only going to be 0.25%, which is also, you could call it 25 basis points, right? And that's supposed to happen March 25th. And the Fed is saying that there's going to be 3 to 4 interest rate hikes over the course of 2022. Why are they raising the interest rates? Well, they want to fight inflation. The way you fight inflation is 2 things. Number 1, you stop printing money. And number 2, you raise interest rates. And that's what they're attempting to do here. But it changes everything. It changes the entire economy. So, when rates go up in real estate, now there's less buyers. It shrinks the buyer pool, especially for the luxury homes, because that's already the smallest buying pool from an affordability standpoint. There's way less people who can afford a multi-million-dollar home than a standard $200,000 home. But when you shrink that buying pool even more, it could be a little bit risky. Doing the high-end luxury type of real estate is the riskiest time. Now, you can get the biggest gains. It can go up the fastest. But in a rising interest rate environment, I certainly don't want to be playing ball in the risky stuff, the luxury stuff. I want to be in the good old-fashioned bread and butter affordable housing. Because look, if we get into an economy where things start to get bad, which I think they're going to over the next several years, people want to be in affordable housing. They don't want to be in the luxury homes. A very small amount of people do. People want affordability because guess what? What's happening? Inflation is happening. Prices are going up for goods and services, but what's not raising is wages.
Yeah.
So, people's cost of living is going up all over the place. But they're not making more money on Friday when they get their paycheck. So they want to be in affordable housing. Less and less people want the luxury stuff when things change and interest rates go up.
I also think that right now, as the interest rates are going to rise, we have to look at like how we're buying a little bit closer and be a little bit more conservative in how we're comparing our ARVs back last year in this time versus what they're going to happen now, and maybe take a conservative approach. So if ARV we're looking at 150,000, maybe have a conservative approach and underwrite our properties at like 130,000. And then your rents also, you can't, this is those times where you can't be so aggressive with your rents. You might have to also come back down a little bit and decrease them. Would you say that's a good idea?
Sure. So when you're underwriting, so you guys all, as aspiring real estate investors or real estate investors, so when you're underwriting something that you're going to make a rental property, you need to factor in a higher interest rate, meaning your payment's going to be higher, meaning it could affect your cash flow. Mm-hmm. So if you're counting on, $300 a month, well, if your payment is higher because rates are higher, it could crunch into your cash flow. You really got to be careful there. And then if you're a house flipper, you really got to pay attention to these ARVs because you buy this property, maybe you use a hard money loan or a private money loan, and you're expecting to sell this thing for $400,000. Well, what if, when rates go up, maybe there's less and less buyers for the $400,000 homes, so you might need to discount that property when you're selling it, so you should price that in when you're underwriting your flips. Be more conservative. I agree 100%. Be more conservative on what you think you're going to sell the property for with a flip and what you think you're going to rent it for a rental, and what your payment's going to be too. So you really want to be conservative for flips and for rentals in a rising interest rate environment.
Gotcha. So guys, if you guys want to check out more interviews or more podcasts like this, go to our YouTube channel. It's The Cream Real Estate Investors. You're also going to see a ton of conversations and value there from Dave and I, talking about how we built this rental portfolio since we've been buying houses for 2012. And we've learned a lot of lessons. And not only bought houses, but we've flipped houses. We've taken properties subject to. Those are the fun ones. And in times like this, when there's a lot of uncertainty, there's people out there that are hurting and they need to, you're going to be solving their problems, and sometimes you need to solve them creatively. So if you're interested in some of our subject to type deals and learning about how to do that, you can do so by going to our YouTube channel. But then also, if you want some of our, we have a lot of freebies for you guys because we want to help. We're here to actually help you guys. So go to rideswiththecream.com. We've got free real estate contracts. We've got our deal analyzer on there. So a lot of free stuff there. And plus, we want to get in touch with you and connect with you guys that are just joining our channel now. We want to connect with you, and hopefully we could probably do some deals with you. Mm-hmm. So
follow us here. Follow us on YouTube, and let's get rich.